Retirement plans don't save you on tax and will end up costing you more in the long run. See, deferring tax is different from saving tax, so why not do what the rich do instead? The rich are getting richer and will get richer during this crisis because this will be the greatest wealth transfer in history. You can use the tax code to your advantage because that's a huge part of it. Look, you're overpaying tax. You already pay enough excise tax, sales tax, property tax, and the list kind of goes on, yet you're still tipping the government with your income tax. The same income tax that goes to give big corporations money during COVID-19 through the PPP and other CARES programs. Okay, maybe they scaled that back. But what about you? In today's times, it's even more important to keep more of what you make and learn the legal tax loopholes. Let me break this down into 3 simple parts for you. Number 1, and when I say simple, I'll make it as simple as it could be, but look, that's part of these tax loopholes is they can be confusing. So the first one is called net operating losses. So this is really designed for businesses because rich people own businesses. And in 2017, they put out this cap on your operating losses as a business owner. You can only take 80% against 80% of your income. Well, since CARES Act and these IRS notices, there's no longer a cap against your income. So you can take higher income years and apply it to other years where you might have had losses or where there was a cap. You can go all the way back to 2015 and bring it all the way to 2020, and you can even carry it forward, which is what most people had to do. But this is a pretty big deal because there's things like R&D credits where maybe you've built a website or modified a CRM or created an app, or there's domestic production credits where maybe you had to have researchers to help you do facts and details in something that you were launching, or there's things like cost segregation if you own a commercial building where you can accelerate depreciation. Now, I get it. If this sounds like a foreign language to you, and you're like, what in the hell is Gunderson talking about? I get it. But you've got to know how to pick the right professional to help you look at this in your own life. And I've got some free resources for you. You can grab it at wealthfactory.com/tax in order to choose the right tax professionals that speak this language. And then their job is to determine what's going on with these loopholes and make sure you know how to legally and ethically apply it to your own life. Net operating losses is a big one that a lot of people are now saving on. All right, let's go to the second one. The rich get tax loopholes because they own assets, especially real estate. Now, there's a thing called a real estate professional designation. It's under Section 469. A taxpayer only may offset losses from a passive activity against income from passive activity. That's the normal thing. Now, this is going to get a little bit technical, but it's extremely important. A passive activity generally includes any trade or business of a taxpayer in which that taxpayer doesn't materially participate, and any rental activities of a taxpayer, regardless of the level of participation. So let's just say that you buy a bunch of real estate, you have rental activity from that real estate, you can only write off passive losses against passive income, and there's a lot of losses that can be created from a tax perspective with real estate. So a rental activity of a taxpayer that qualifies as a real estate professional under Section 469 C7 is not presumed to be passive and will be treated as non-passive if the taxpayer materially participates in the activity. So what qualifies you as a real estate professional is more than 1/2 of the personal services the taxpayer performs in trades or businesses during that tax year or in real property trades or businesses in which the taxpayer materially participates with real estate. Number 2, if we just take all those hours and we add them up, and it's more than 750 in the year. So what this means is where you'd normally have limitations on what you could write off, you now have more unlimited opportunity to write those off. So in real estate, you've got depreciation. Now depreciation, you can have a building that's growing in value, but you get to depreciate it for tax purposes. So maybe you have to replace the carpet or the lights or paint the walls or technology that operates that. That is what is known as depreciation for tax purposes, regardless of the increased value of the building. There's also loan interest that you might be paying if you're acquiring the properties with loans, right? So there's other business expenses you might have for travel or for different things with that real estate business. If that can now be written off as active instead of passive, that goes against any and all of your income. Now, the third component of these tax loopholes of the rich, and this is one of the most major ones, is to reclassify income. Reclassification of income comes from the type of corporations you choose and how that income comes in according to taxes. So one way is to have active income, which is W-2 income if you're an employee, right? You just get this paycheck, and you have to pay part of this, FICA FUTA, which is, 7.5% essentially, and then, you have to pay regular taxes on that, and so it's taxed at a pretty decent rate, where if you're a business owner, you can take a reasonable salary and take the rest in distributions, and those distributions are treated as a passive income, which is not subject to the FICA FUTA self-employment tax, which can save you up to 15.3%. So that's a big way to reclassify income, is the type of corporation you choose and how you pay yourself. Now, another way is moving from ordinary income to capital gains. So how do we move to capital gains? Well, could be as simple as selling a piece of a business, having a piece of real estate that you've owned longer than a year, that becomes capital gains, anything that's a capital gain type of asset. But it could also be how you take your income. If you're doing business internationally, you can set up an ICDISC, an International Sales Corporation. That money comes in as capital gains instead of ordinary income. So if you can learn, once again, to own a business and have those businesses, you might move from a higher tax rate, which at the top might be 37%, down to 21%. There's another thing called Section 199A. This is the pass-through deduction. And with the new IRS notices, there's less limitation on this pass-through deduction thanks to 2020 and this, financial situation that we're in and some of the CARES Act. So this might change your income drastically. And if you don't know about 199A, that is a big thing to reduce your taxable income. Now, another way to reclassify income is known as tax-free income, right? Sounds pretty simple and straightforward. Well, let me give you a few examples of tax-free income. There's a thing called a Section 1202 for businesses that sell as a C corporation. They've been around for a certain amount of time, but not before sometime in the 1980s. You can sell up to $10 million tax-free. Or charitable remainder trust. These are strategies where you can donate a capital gain asset to a charity, get a tax deduction for part of that donation, and then it funds a trust, which you're the first beneficiary of. You're just agreeing that you intend to leave at least 10% behind to the charity. So it actually avoids tax upon the sale and can actually create a tax deduction. And when you die, the charity keeps whatever's left over. That's why it's a charitable remainder trust. There's also other things to look into, like donor advised funds. But let's go through just a few additional advanced strategies of the rich. And these are the ones you got to be really careful with. You got to have the right team. It's got to be done properly. I've seen people abuse these or not do them correctly, and therefore they're subject to audit potential and potential penalty. One would be conservation easements. These are where maybe you own property, but you donate the development rights to that property, and you get a massive tax deduction depending on the value of those development rights. There's a thing called the captive insurance agency, which is where companies like Geico got their start, where you actually have your own insurance company that you fund and maybe eliminate some insurance costs that you're now covering yourself, and that goes in pre-tax, and if it's not used because there's no insurance claim, you get to take out as a capital gain. There's things called wings and nings for those people in high tax areas like New York or California. There's ways that if you have clients outside of your states, you can run it through Wyoming with a wing or Nevada with a ning, and you can avoid state tax, but it is at your highest marginal rate when it goes through there. But I'm just giving you a flavor of all that's available out there. There's so much that can be done in tax. There's so many loopholes that people feel intimidated because they're worried, well, will I get audited? Well, if you're doing something internationally, you have a higher chance of audit. If you're not reporting your income, that's when you get in trouble. Report your income, but then make sure to maximize your write-offs. And everything I'm sharing is stuff that's either in the tax code or with tax attorneys and legal agreements. So it's about doing it right and having the right team behind you. You can go to wealthfactory.com/tax to figure out how to create that right team. There's some free and great resources there for you. I think that far too many people are deferring taxes and delaying taxes, not saving them. And we're putting trillions of dollars into the economy right now through printed money that there hasn't been value created for that. We have a lot of debt that's been piling up. How does the government pay for that debt? Well, they can either print more money and devalue the cash, or they can raise taxes. What if they raise taxes and you're deferring taxes into the future? Well, you might end up paying more tax for these retirement plans that felt like they were saving you now, but they weren't. There's other mistakes people make by spending $1 to save 37 cents. Look for permanent tax strategies that don't just defer or delay tax, or you don't have to spend $1 to save 37 cents. Don't let the tax tail wag the dog. Instead, look for permanent strategies that come from allowing you to keep your money, continue to invest it in the way that you want, not being incentivized into things that aren't right for you. Retirement plans aren't going to save you tax, and they end up costing you more in the long run. Deferring tax is different than saving tax, so why not do what the rich can do instead? In today's climate, it's even more important to keep more of what you make and learn the legal tax loopholes. Now, you have the knowledge to transform your thoughts into profits and keep way more of what you make and build a life you love. If you're looking more on this topic, check out my video on how to avoid taxes. You'll learn strategies to stop tipping the IRS on your taxes in addition to what you learned here. I'll see you there.